Welcome back to Intelligent Investment Today, the podcast that examines the world of value investment through the timeless wisdom of its founding thinker, the father of the craft and teacher and mentor to Warren Buffett. We're of course talking about Benjamin Graham. In each episode we explore a different aspect of Graham's teachings, as well as broader investment themes, uncovering why value investing has rewarded disciplined practitioners for decades and continues to do so today. I'm your host, David Coombs, and in today's episode we're diving into a topic that sits at the very heart of Graham's philosophy, and something long-term listeners will have heard me speak about before. Yet it is something so important to our philosophy that it bears repeating. That is, understanding the difference between investment and speculation. Now on the surface, that might sound simple enough, perhaps even too simple. After all, most people assume they already know the difference. But Graham strongly believed that this single distinction forms the very foundation upon which all sound investment practice must be built. Without a deep working understanding of what separates a genuine investment from a mere speculation, it's almost impossible to apply the rest of his principles with any degree of consistency or success. History has demonstrated time and time again that even highly intelligent individuals, people with advanced finance degrees, experienced market analysts, professional managers, even Nobel Prize winners, often miss this fundamental point. They think they're investing when in reality they are speculating, and the financial consequences of that confusion can be severe. That is why understanding the difference between investment and speculation doesn't just help value investors, it helps anyone who participates in markets avoid unintended risks and ensure that when risks are taken, they are taken knowingly, intentionally, and with clear awareness of what is at stake. So without further ado, let's get right down to it. As ever, sit back, strap in, and get ready for another lesson in value investing as inspired by Benjamin Graham. One of the great problems in the investment world today is the loose and often careless way in which the terms investment and speculation are used in everyday speech. In media headlines, on podcasts, on social platforms, and in casual conversations, almost every financial action is now described as investing. Buying a trendy meme stock, that's apparently investing. Jumping into a cryptocurrency you heard about last week, also investing. Leveraging options to chase a quick gain, somehow that too has been lumped into the investment category. And of course people naturally prefer to think of themselves as investors. It sounds responsible and respectable. The word speculator, on the other hand, makes people uncomfortable because of its association with gambling, short-termism, and reckless behaviour. Few people want to acknowledge that they are essentially betting. Yet speculation itself isn't inherently wrong. It plays an essential role in financial markets, and it always has. What is dangerous, however, is when someone speculates under the mistaken belief that they are investing, because that misunderstanding leads to risks they never intended to take. So what exactly distinguishes the two? At the heart of it, investment and speculation differ in the level of risk that is taken, the time horizon over which that decision is made, and the underlying reasoning that supports the purchase of an asset. A true investment involves the purchase of a business or an asset after careful analysis, with the intention of generating income or capital appreciation over the long term. Benjamin Graham famously defined an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that does not meet that criteria, he insisted, is speculation. Speculation, by contrast, is centred on short-term price movements. The speculator aims to profit from an expected rise or fall in price, but this expectation is usually supported by little or no evidence. The decision often rests on market sentiment, excitement, or the belief that someone else will buy the asset at a higher price still. The speculator's focus is rarely on the underlying business itself. It is instead on what the market might do next. So let's break these differences down more fully. A genuine investor makes decisions through careful analysis of the fundamental factors that determine a company's long-term value. This includes examining its financial statements, understanding the competitive landscape, assessing industry trends, evaluating management quality, as well as identifying risks and opportunities. The investor understands that markets do not always price securities accurately. Companies can be temporarily undervalued or misunderstood, and it might take years for the market to recognise their true worth. That time horizon is perfectly acceptable to the investor, who is patient and focused on long-term outcomes. A speculator, on the other hand, is focused on short-term movements in price. They're often concerned less with what a business is worth and more with what its shares might sell for in the near future. Their decisions might be driven by trends, rumours, technical patterns, or simple enthusiasm. Many speculative activities, such as day trading or options trading without robust understanding, rely on rapid movement and rapid reaction. The horizon is measured in minutes, hours, or days rather than in years. Unsurprisingly, this carries a level of uncertainty and volatility far greater than traditional investing. And unfortunately, although quite predictably, many speculators overestimate their ability to predict the market, leading to outsized losses. But again, speculation itself is not the villain here. Markets need speculators because they provide liquidity, take risks on early-stage ventures, and help new technologies find their footing. Many transformative companies, from tech giants to revolutionary innovators, benefited greatly from early-stage speculation. The issue is not that speculation exists. It's that people often engage in it without realising that this is what they're doing. If you want to speculate, that is absolutely fine. Just do it with money you can afford to lose. And make sure you clearly label it as speculation rather than investment. Keep your speculative activities separate from your long-term investment portfolio. And understand the different mental frameworks required for each. One of the clearest ways to tell the difference between investment and speculation is to look at where each approach draws its justification. Investment is rooted firmly in the past. Investors use demonstrated historical performance, real numbers, real profits, real cash flow to inform their decisions about the future. The future matters, of course, but it is not assumed to be brighter than the past, unless strong evidence suggests otherwise. Investors focus on what the business has already proven it can do. Speculation, by contrast, is rooted primarily in the future. The speculator believes that future results will be significantly better than past ones. This belief is often based on intangible factors, the sort of things that are hard to measure or quantify with any degree of confidence. They may include the charisma of a particular CEO, the potential of an emerging technology, or a compelling narrative about growth. And none of these things are inherently bad. Far from it. Many companies with great narratives do go on to justify the hype. But these qualitative factors are extremely difficult to value. They create a space where rumour, excitement and emotion can easily overpower disciplined analysis. Imagine, for example, a celebrated entrepreneur taking charge of a new company. A speculator might decide that this alone justifies the purchase of its shares. But even if the entrepreneur really is brilliant, how exactly do you place a value on this brilliance? What premium makes sense? $10 above fair value? 100? 1,000? There is simply no objective way to quantify such a premium. And markets have often demonstrated a tendency to overvalue these intangible qualities. Investors too consider qualitative factors such as management quality or innovation potential, but they do so after their quantitative analysis has already shown that the company appears undervalued based on financial results alone. Qualitative insights serve to support or challenge what the financial data demonstrates. They do not replace it. An investor might find a company financially attractive and then grow more confident upon learning that its management team has a strong track record. Conversely, if a company looks financially sound but operates in an industry whose long-term prospects are uncertain, the investor might decide the risks outweigh the potential rewards. The point is that the qualitative factors refine the investment decision. They do not drive it entirely. So when we bring everything together, we can say that investment is a long-term, evidence-based approach, grounded in careful study of past performance and supported by a rational assessment of future potential. It seeks to identify discrepancies between the market price of a business and its intrinsic value. It is patient, disciplined, and focused on long-term financial outcomes. Speculation, on the other hand, is short-term and emotionally charged. It seeks to profit from market movements rather than business fundamentals. It relies heavily on predictions about the future, predictions that may or may not be supported by evidence. It is perfectly legitimate, but it must be approached with caution, self-awareness, and funds you're prepared to lose. The greatest danger in financial markets is not speculation itself. It is the unrecognised blending of speculation into what people believe is their investment strategy. Every gambler at the racetrack believes they are betting on a sure thing. Every speculator who chases the latest trend believes they are acting on insight. But belief does not eliminate risk. And that brings us to the end of this episode of Intelligent Investment Today. I hope you found this exploration and reminder of Benjamin Graham's distinction between investment and speculation both illuminating and practical. It is one of the foundational ideas in the value investing tradition, and keeping it at the forefront of your mind at all times will give you a powerful advantage over the average market participant. Thank you for tuning in. If you haven't done so already, please do remember to subscribe so you don't miss any future episodes. If you've been enjoying the show, I would be incredibly grateful if you could share it with friends, colleagues, or with anyone else who you might think will benefit. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.